In my last video, I told you about mortgage relief options, namely forbearance. In this video, I'm going to tell you why you should absolutely avoid it if you can. I'll show you why. Here is why I don't recommend the forbearance unless you absolutely have to. Let's look at the forbearance. So the forbearance is really just a payment postponement up to 12 months right now. That's what most servicers and lenders are offering. So if you postpone your payments for 12 months and let's say you have a 24-year loan, you have 24 years left on your loan, you're just gonna have at the end of the 24 years plus 1 year of mortgage payments. So that's what the forbearance is. Now, why I'm telling you to avoid this is because when you're not making 12 months of mortgage payments and the rates are gonna come even more down in the next few months, then you're not going to be able to prove that you made the last 12 months of mortgage payments, and that is what I'm hearing is going to be one of the conditions of getting a new loan. So even though your credit doesn't reflect negatively, but you cannot prove that you've made your mortgage payments. And the lenders, when you're trying to refinance, they're not going to let you do a new loan. They're not going to lend to somebody who just missed basically the 12 months of mortgage payments. So here, you're not really saving any money. You're just postponing it, and you have, instead of 24 years, now you're gonna have 1 more year at the end, or whatever the number of years you had left, you're just gonna have 1 more year if you postpone your payments for 12 months. But if you can make the payments, and in a few months, who knows, maybe the end of this year, maybe sooner, maybe early next year, when the rates come down again, even more than they are now, because they're still very, very low, then if you have, then you can refinance and take advantage. So the refinance would look like this. Let's say you have a $300,000 mortgage at 4.125% currently. So your mortgage payment is on a 30-year term. Your mortgage payment is $1,453.95. Okay. Now, if you can lower this to, let's say, 3.1%, because the rates are going to be lower, then we're just going to change the payment to 3.125 is the interest, and the payment is going to be $1,285.13. So then if you deduct from the 1453 the 1285, so let's do that. 1453.95 minus 1285.13, you're gonna save $168 a month, $168.82 per month, and that's savings. So, if you project it over, let's say you going with the previous example, you have 24 years left, so times 24 times 12, because there's 12 payments in each year, then you're gonna have, basically you're saving 48,000, you can see this, $48,620.16 over the life of the loan. So forbearance, not really saving anything. If you keep making the payments and you're able to refinance when the rates come even lower down than what they are now, you're gonna have much more significant savings if you can wait and refinance, or if you refinance and not miss the payment. So forbearance, yes, if you absolutely cannot afford to make your payments, call your servicer and work out a deal with them. But if you can, keep making your payments, and then when it makes sense to refinance is gonna be a lot more sense. It's gonna make a lot more sense. Thank you for watching. Call us with any questions, and I hope everybody's safe.